If 2018 was the year of the IPO, 2019 is expected by many to be more or less the same trend. The IPO is synonymous to the American dream. Every now and then, an exciting company is founded by entrepreneurial fortitude and receives admiration from the public and business world. We often hear if you invested X amount of dollars in so-and-so company, you'd have X amount of million. And every stock market investor dreams of hitting their big home run, the concept of one day retiring with millions and millions from a stock that was once your little darling turned empire right before your eyes. In many ways, passionate investors see stocks as no different than their children. Watching as they grow, we can't help but shed a tear and be proud of the outcome. However, we want to talk today about a few reasons why you should stay away from IPO investing. Number one is conflict of interest and information. When a company goes public, you don't have as much data to work with as a company that's been public for a longer period of time. And the historical comparison serves as reference. This lack of information puts the investor in a tough position as to anticipating where the business will go furthermore. After all, the private markets and the public markets are two very different beasts. And the conflict of interest lies in the fact that the CEO and executive team of a company going public intends to raise as much capital as possible, meaning they want you, the investor, to pay as much as possible for the shares of that company. After all, they need that money. It's the reason they're going public in the first place. So in other words, the CEO and executive team of a company that's going public, for a short period of time, have to really bang the beat of their drum and kind of give a presentation and create hype. The better the company looks, the better their IPO is, which often means in some cases, stretching the truth in regards to the fundamentals of a company. There are a number of things a CEO can possibly do, which has many professional investors skeptical about IPO investing. For example, if I know and anticipate that in a few years I will become a publicly traded company, I can relieve the gas pedal on a number of expenses to make my margins look better, to make my profits look better, where there is no real detriment in the short term, but in the long term may hurt the company. For example, I can cut some advertising expenses, I can cut some R&D. These don't hurt the company instantaneously, and therefore we don't necessarily see any real movement of magnitude on the company's fundamentals. Returns and historical data. We don't like IPO investing simply because of opinion. There is a fact-based argument to be made. A plethora of data suggests investors who invest in IPOs see weaker returns. If you combine the cumulative return of IPOs, you underwhelmingly perform relative to the market. Jeremy Siegel, a famous author and professor in the business world, talks about this in his book The Future for Investors, in which they examined nearly 9,000 stocks that went public since 1968. The study assumed that each stock was bought at either the offer price or at the end of the first month of trading, and was held until the end of 2003. The findings may shock you, as IPOs were found to underperform the market by an average of 2 to 3% per year. In the book Contrarian Investment Strategies by David Dreaman, the results are similar. He studies 2,800 IPOs in the 1970s and 80s, and the conclusion he found was that they again significantly underperformed the market. And lastly, our third point is about hype and bubbles. The stock market, as you know, follows a cycle. It has ups and downs, and in many ways is largely dependent on the cycle of the economy. Well, believe it or not, the IPO market has a cycle as well, and it follows the stock market. As the value of the stock market rises up and down, the IPO market tends to follow it. The reason is when shares in the market are trading at a premium, if you are undergoing an IPO, you are more likely to trade at a similar premium. When the economy is in a depression and therefore the markets are selling at lows, you probably do not want to conduct an IPO. It may be in your best interest to wait until the market is in better shape. Here's the IPO market in the last decade or so, both in volume and in terms of dollar amounts. As you can see, less IPOs tend to happen during tumultuous financial times. Famous financial crashes show this more clearly. What does this mean for the average investor? It means when you see in the media that there's all this IPO activity and it's leading to a lot of frenzy, it's best to take a step back and think about what we talked about in today's video. Patience is one of the most rewarding characteristics of a successful investor. And with hype and bubbles, historical data, and the conflict of interest and information argument that we just presented, we like to think that there's no need to jump into any IPO investment ever so eagerly. Give us a comment and subscribe if you like what you hear, and happy investing.